Silver traded as a footnote to gold, priced quietly through a web of futures contracts, refinery flows, and assumptions that demand would always remain predictable until that assumption stopped holding. For years, pricing models treated silver as globally interchangeable, yet recent market behavior suggests that the metal is no longer moving as a single pool, and the divergence didn't begin where most traders were watching. Historically, price discovery for silver was anchored in Western financial centers, shaped by liquidity, leverage, and the belief that physical supply could always be sourced if paper contracts demanded it. For most participants, that structure felt stable enough to ignore regional demand signals, but stability has a way of masking pressure until it concentrates somewhere unexpected. At the institutional level, China was never supposed to matter this much to silver pricing. For a long time, its role was framed as industrial consumption and jewelry demand, absorbed smoothly by global inventories, until domestic buying patterns began to separate from international benchmarks. Quietly, premiums inside China started behaving differently than prices outside it. What looked like minor dislocations at first gradually revealed a deeper issue. Physical silver in one market was no longer responding to signals from another. Behind closed doors, refiners, traders, and logistics firms began adjusting routes and contracts. Those adjustments weren't driven by headlines or speculation, but by delivery constraints that made certain trades uneconomical almost overnight. On trading desks, the question shifted from where silver was priced to where it was actually available. Once that distinction mattered, the logic of a single global price began to weaken in ways models weren't designed to explain. At ground level, Chinese demand didn't surge in a dramatic spike. It accumulated steadily, shaped by industrial policy, renewable expansion, and domestic investment behavior that didn't rely on Western futures markets for validation. In policy circles, silver's strategic relevance quietly expanded alongside energy transition goals. The metal's role in photovoltaics and advanced electronics created demand that couldn't be easily deferred, especially when domestic supply chains were prioritized. Inside China's market structure, access to physical silver operates under different incentives. Capital controls, import rules, and local inventory management meant that when demand tightened, prices adjusted internally rather than exporting the pressure outward. For global traders, this created an uncomfortable mismatch. Paper prices reflected abundant supply, while physical flows into Asia suggested tightening conditions that futures curves failed to acknowledge. On balance sheets, arbitrage opportunities appeared and then vanished. The cost of moving metal, financing it, and securing delivery eroded the clean price signals that global markets rely on to stay synchronized. In risk meetings, the conversation stopped being about volatility and started being about fragmentation. If silver could trade at a sustained premium in one of the world's largest consuming markets, the idea of a universal price began to look more like a convention than a fact. From a distance, the gap looked manageable. Up close, it hinted at structural stress between financial pricing and physical demand that no longer reconciled automatically. In market behavior, these gaps don't close politely. They widen until something is forced to adjust, and the adjustment rarely happens where participants expect. At this stage, the silver price gap isn't a curiosity. It's a signal that the global market may be misreading where real demand is asserting control, and that signal hasn't finished transmitting yet. For years, the assumption was that any regional imbalance in silver could be smoothed out through trade, inventory releases, or paper hedging. That assumption depends on trust in logistics, financing, and timing, and each of those has started to behave less reliably under current conditions. In China's domestic market, silver doesn't function primarily as a speculative instrument. It's treated as a strategic input, and when inputs tighten, price sensitivity shifts from traders to end users who can't simply walk away. Available data suggests that industrial buyers increasingly prioritize security of supply over marginal price differences. Once that mindset takes hold, premiums stop signaling temporary shortages and start reflecting structural demand. For international sellers, the math became uncomfortable. Exporting silver to China meant tying up capital longer, absorbing regulatory friction, and facing settlement risks that didn't exist in traditional trading hubs. As those frictions accumulated, fewer participants were willing to arbitrage the gap. The market didn't correct the price difference because the incentive to do so weakened faster than expected. On futures exchanges, open interest and liquidity still suggested normal conditions, but futures don't measure urgency, and urgency is what drives physical markets when inventories thin. Inside vault networks, bars that were technically available became operationally unavailable. They existed on balance sheets, but not on trucks, not on ships, and not on the timelines buyers needed. In parallel, Chinese refiners and fabricators adjusted procurement strategies. Rather than waiting for global prices to soften, They locked in supply, reinforcing the very premium they were reacting to. This created a feedback loop that pricing models struggled to capture. Rising domestic prices justified further preemptive buying, which in turn reduced the effectiveness of imports in easing pressure. In global markets, the signal was muted. Price discovery mechanisms emphasized traded volume over delivered metal, leaving physical tightness underweighted. Risk managers noticed something subtle but troubling. Hedging costs were rising even when headline prices weren't, a sign that liquidity and availability were diverging. From the outside, it looked like inefficiency. From inside the system, it looked like a growing disconnect between financial abstractions and material reality. As the gap persisted, it began to influence behavior beyond China. Other buyers watched closely, recognizing that if one major market could decouple, others might follow. At that point, the issue stopped being regional. It became a test of whether the global silver market still functioned as a single integrated system. And once that question is on the table, every participant has to reassess assumptions they haven't challenged in decades. For a long time, global silver pricing relied on the belief that inventories were deep enough to absorb shocks without signaling stress. That belief rested on reported stockpiles, not on how quickly those stockpiles could be mobilized when demand concentrated in one direction. As Chinese demand drew metal inward, the drawdown didn't trigger alarms in Western markets. Inventories still appeared sufficient on paper, but availability became uneven in ways reporting systems weren't built to flag. In logistics data, delivery times quietly stretched. What had been routine shipments turned into scheduling exercises, with delays that reflected congestion rather than outright shortage. Those delays mattered more than price. For industrial buyers, missing a delivery window can disrupt production far more than paying a premium, and that calculus shifted behavior decisively. Within China, this reinforced a preference for local inventory. Holding silver domestically became a form of insurance against external volatility that futures contracts couldn't replicate. Outside China, traders misread the signal. They saw premiums as transient anomalies rather than evidence of demand asserting itself through physical channels. In response, paper markets continued to price silver as if substitution and delay were always available. But in applications tied to energy infrastructure and electronics, substitution isn't immediate, and delay carries costs. This mismatch created stress along the supply chain. Producers faced conflicting incentives between selling into futures-driven markets and fulfilling contracts where delivery certainty commanded higher margins. Gradually, metal began flowing toward where commitment was strongest rather than where price was lowest. That inversion undermined the traditional logic of arbitrage that keeps global prices aligned. In boardrooms, discussions shifted from optimizing exposure to securing relationships. Long-term supply agreements gained priority over spot market efficiency. As these agreements multiplied, they reduced the volume of silver available for open trading. Less free float meant that price signals carried less information about real-world conditions. At the same time, policy considerations loomed in the background. Strategic materials tend to attract attention when they intersect with national priorities, even if no formal controls are announced. Market behavior implied anticipation rather than reaction. Participants acted as though future constraints were more important than current abundance. That anticipation has consequences. It embeds caution into pricing decisions and encourages hoarding behavior that amplifies regional differences. By the time these effects become visible in headline prices, the underlying shift is usually well advanced. And in silver's case, the shift was already influencing how participants defined risk itself. At that point, the price gap stopped being a symptom. It became a mechanism through which the market was reorganizing, whether participants acknowledged it or not. As the market adjusted, attention turned to the institutions that sit between physical metal and price discovery. These intermediaries are designed to absorb friction, but only as long as flows remain balanced. In recent months, clearing mechanisms began to show strain, not through failure, but through subtle changes in margin behavior, delivery preferences, and contract roll dynamics. Participants who typically rolled positions forward started opting for settlement flexibility. That choice hinted at unease, not panic, and unease often precedes structural change. In China, exchanges and vaulting systems operate under a different set of priorities. They emphasize delivery integrity and domestic circulation over global price alignment. This divergence complicated cross-border hedging. Hedges priced in one market no longer neutralized exposure in another with the same precision. As a result, some firms reduced exposure rather than increased complexity. Less participation from these actors further thinned the connective tissue between markets. In pricing models, correlations began to loosen. Silver still tracked broader commodity trends, but deviations became harder to dismiss as noise. What made this uncomfortable was timing. The divergence emerged during a period of relatively calm macro conditions, not during a crisis that could easily explain it away. Historically, dislocations are tolerated when stress is visible. When they appear during stability, they suggest forces operating beneath the surface. In China's domestic context, policy signaling remained indirect. There were no dramatic announcements, just consistent alignment between industrial planning and resource procurement. That consistency gave buyers confidence to commit. Confidence, once established, tends to reinforce demand rather than moderate it. Outside China, the response was slower. Market participants accustomed to reactive pricing underestimated how deliberate the shift had become. As weeks turned into months, the gap persisted without resolution. Persistence changed perception, turning what was once a curiosity into a reference point. Once a reference point exists, behavior adapts around it. Contracts, expectations, and risk premiums begin to reflect the new normal. At that stage, even a temporary easing wouldn't restore the old equilibrium. The memory of divergence alters future decisions long after the immediate pressure fades. This is how markets fragment without breaking, not through collapse, but through gradual reorientation that only becomes obvious in hindsight. As fragmentation set in, the question shifted from whether the gap would close to who would bear the cost if it didn't. In markets like silver, costs rarely stay localized. They migrate through financing, insurance, and contract structure. Banks that facilitate metal trading began reassessing exposure quietly. When physical settlement risk increases, capital allocation changes, even if prices appear stable. That reassessment altered liquidity in subtle ways. Credit terms tightened selectively, not across the board, signaling preference rather than alarm. For producers, this created a fork in incentives. Selling into liquid paper markets offered speed, while supplying committed buyers offered certainty, and certainty started to command a premium. Over time, that premium reshaped production flows. More output was earmarked before it ever reached open markets, reducing the pool that underpins global pricing. In China, this reinforced a sense of insulation. Domestic buyers faced higher prices but gained reliability, which in strategic industries often outweighs cost concerns. Outside China, the effect was inverse. Markets priced silver as though availability remained elastic, masking the gradual withdrawal of metal from discretionary trade. This discrepancy created false comfort. Headline prices suggested balance, while underlying access grew more constrained for those without long-term arrangements. In derivative markets, volatility remained contained, but stability built on shrinking physical optionality tends to be fragile, even if it looks calm. Risk officers noticed duration mismatches. Hedges extended further into the future than physical coverage could realistically support. That mismatch doesn't trigger immediate consequences. It accumulates quietly, surfacing only when delivery expectations collide with constrained supply. Meanwhile, information asymmetry widened. Participants closest to physical flows adjusted behavior earlier, while others relied on signals that lagged reality. This asymmetry isn't malicious. It's structural, and structure determines outcomes more reliably than intent. As awareness spread, the gap itself became a strategic variable. Some actors positioned around it, while others tried to ignore it, hoping reversion would do the work for them. History suggests that hope isn't a strategy. When markets reorganize, they rarely revert to earlier configurations without external force. By this stage, silver wasn't just mispriced across regions. It was being valued under different assumptions about what access, reliability, and control actually mean. And once assumptions diverge, prices tend to follow, whether the system is ready or not. As the divergence deepened, attention turned to the mechanisms that normally enforce convergence. Arbitrage, logistics, and financial intermediation are supposed to close gaps, but only when conditions allow them to function smoothly. In this case, each mechanism encountered friction at the same time. Transportation costs, regulatory layers, and financing constraints combined to blunt the force that usually equalizes prices. The result wasn't paralysis, it was selective movement, where only the most committed flows continued and marginal trades disappeared. That selectivity altered market tone. Price became less about discovery and more about signaling access to supply under constrained conditions. In China's market, buyers interpreted price increases as confirmation of scarcity. In global markets, the same increases were often dismissed as noise, reinforcing divergent behavior. This divergence created timing risk. Those waiting for convergence risked being locked out, while those acting early absorbed higher costs in exchange for certainty. Over time, certainty gained value. In industries tied to infrastructure and energy, interruptions carry cascading effects that prices alone can't capture. That dynamic encouraged preemptive procurement. Metal was bought not because it was cheap, but because it was available. In Western markets, this logic was slower to take hold. Abundant paper liquidity created the impression that physical supply could always be summoned if needed. But paper liquidity doesn't move metal. It reallocates claims, and claims only matter if they can be honored on schedule. As delivery expectations grew more explicit, contract language tightened, optionality declined, and flexibility began to carry a price of its own. This had implications beyond silver. It challenged assumptions about how commodities with dual financial and industrial roles behave under sustained demand concentration. Market veterans recognized the pattern. It resembles early stages of segmentation seen in other materials before policy or structural shifts formalized it. At this stage, no single event forced the issue. Instead, a series of rational decisions compounded into a collective outcome that few had planned for. The gap, once a statistical curiosity, now functioned as a boundary. Crossing it required more than capital. It required alignment with the priorities of the receiving market, and boundaries, once established, tend to reshape the landscape around them. As the boundary solidified, secondary effects began to surface in places not directly tied to China. Markets that had relied on spillover supply found that availability was less predictable than pricing suggested. In these regions, buyers started reassessing assumptions about just-in-time procurement. When delivery certainty weakens, inventories stop being a cost center and start looking like risk mitigation. That shift altered demand timing. Purchases moved forward, reinforcing tightness without any visible surge in end-use consumption. From the outside, this looked irrational. From inside supply chains, it was a logical response to losing confidence in global synchronization. Meanwhile, producers faced growing informational gaps. Signals from futures markets conflicted with inquiries from physical buyers willing to commit early. Choosing between them wasn't trivial. Once supply is pledged, reversing course is costly, and that cost factors into long-term strategy. As more metal was spoken for ahead of delivery, spot markets thinned further. Thin markets don't need large shocks to move. They need imbalance, and imbalance was already present. In pricing behavior, small trades began to matter more. When liquidity narrows, marginal transactions carry outsized signaling power. This heightened sensitivity created fragility beneath apparent calm. Prices looked orderly, but order was maintained by reduced participation, not by restored balance. At the same time, narratives diverged. Some framed the gap as temporary distortion, others as early evidence of a re-tiered market. That disagreement itself became a risk factor. When participants don't share the same model of reality, coordination breaks down. Institutions closest to physical flows adapted first. Those further removed continued to rely on abstractions that had worked in the past. History shows how that tends to resolve. Adaptation spreads unevenly until a triggering event forces alignment under pressure. At this point, silver wasn't awaiting a catalyst. It was accumulating conditions where any disturbance could have disproportionate impact. The gap had done its work quietly. It had rewired behavior, expectations, and incentives without requiring crisis to announce itself. What remained uncertain was not whether the system had changed. It was how much strain it could absorb before that change became impossible to ignore. As pressure accumulated, the final layer of risk moved into view, not through price spikes, but through dependency. When markets fragment, resilience depends on how many alternatives remain, and silver's alternatives narrowed quietly. In China's case, dependency was managed through planning. Supply was diversified, contracts were layered, and exposure to external volatility was treated as something to be minimized, not traded. Elsewhere, dependency remained implicit. Markets assumed access because access had always been there, an assumption that only gets tested when it fails. This imbalance changed negotiating power. Those controlling physical flows gained leverage over timing, terms, and delivery. Even if headline prices didn't reflect it, in parallel, confidence in benchmarks weakened. A price that doesn't guarantee availability stops functioning as a reference and becomes a suggestion. As confidence eroded, behavior adjusted again. Participants placed less weight on spot signals and more on relationship-based intelligence. That intelligence doesn't circulate evenly. It concentrates among those already embedded in physical networks, widening the gap between insiders and observers. From a systemic perspective, this matters. Markets rely on shared information to allocate resources efficiently, and fragmentation undermines that function. Silver's role as both industrial input and financial asset intensified the effect. Each role responded to different incentives, pulling the market in opposing directions. The result wasn't disorder, it was bifurcation, where one price governed contracts and another governed reality. Over time, such bifurcation forces a choice. Either pricing adapts to reflect physical constraints, or physical markets detach further from financial ones. Neither outcome is neutral. Both redistribute risk in ways that only become obvious after decisions are locked in. By now, the silver price gap wasn't just reflecting Chinese demand. It was revealing how much of the global market depended on assumptions that no longer aligned. What remains unresolved is how this recalibration finishes. Whether through gradual adjustment or abrupt recognition depends less on silver itself and more on how participants respond to the signals already in front of them. For decades, silver's global market relied on the idea that price alone could coordinate supply, demand, and risk across borders. What the growing gap has exposed is not a failure of price, but a limit to what price can do when priorities diverge. Chinese demand didn't break the market through aggression or excess. It revealed a fault line that already existed between financial convenience and physical necessity. As long as silver was treated as abundant and flexible, that fault line stayed invisible. Once demand became deliberate and supply became less optional, the separation surfaced naturally. This isn't a story about shortage in the simple sense. It's about control, timing, and who gets served first when logistics, capital, and policy no longer point in the same direction. Markets can function with imperfect information. They struggle when participants operate under different definitions of risk. The silver price gap signals that those definitions are no longer shared. Some actors price for liquidity, others for certainty, and the difference between the two now has a cost. Whether the system adapts smoothly or under pressure remains open, but the adjustment is already underway, embedded in contracts, inventories, and decisions that won't easily reverse. In that sense, the gap isn't the disruption. It's the evidence that the global silver market has entered a new phase, one where alignment can no longer be assumed and where demand, once concentrated, quietly reshapes everything around it.